Looking for ways to get the lowest mortgage rates in 2023? It's no secret that the housing market is currently facing a unique set of challenges. With higher mortgage rates and fewer homes on offer, it's more important than ever to understand the ins and outs of mortgage rates. Knowledge is power, and by understanding how these rates work, you can take control of your home buying journey. Here are 5 strategies to secure the lowest mortgage rates for your next home loan. The first strategy is buying discount points. Now, discount points are a way for you to lower your mortgage interest rate by prepaying a portion of it. This strategy becomes particularly popular when the interest rates are high. Imagine it like this. Each point you buy is equal to 1% of your loan amount. By purchasing a point, you can generally reduce your interest rate by 1/4 of a percentage point. You can buy as many points as you want, and yes, even fractional amounts are allowed. But here's the catch. It's crucial to calculate the upfront costs of buying these points and compare it with the long-term discount you'll receive on your interest rate. Think about how long you plan to live in the house. Consider your down payment. These factors will help you decide if buying points is a smart move for you or not. Now, let's talk about lenders. Sometimes, they might add a point or two to their mortgage proposal to make their offered interest rate look more attractive. But keep in mind, you're the one who's paying for this discount with an upfront fee. So here's a tip. When you're shopping around for a loan, try comparing loan offers with 0 points. This will give you a clear picture of the true cost of the loan. Once you have these offers, you can then decide whether to buy points to lower your interest rate further. In summary, buying discount points can be a beneficial strategy, but it requires careful consideration and calculation. It's not a one-size-fits-all solution, but for some, it might be the key to securing a more affordable mortgage rate. Remember to compare loan offers with 0 points before deciding to buy points. This way, you'll have a better understanding of whether buying points is a good strategy for you. The second strategy is an interest rate buy-down. An interest rate buy-down is a financial maneuver where you, the borrower, can lower the mortgage interest rate for the first few years of the loan term. This strategy is sometimes offered by home builders, sellers, and even some lenders to incentivize sales. However, it's important to note that this option is quite rare among mortgage lenders. Over the course of a year, ending in June 2023, only a handful of non-bank lenders were responsible for the majority of buy-downs, making up about 80% according to Freddie Mac. Now, let's look at how a buy-down works. For instance, a buy-down might reduce your interest rate from 7% to 6.5% for the first 2 years. While this may seem like a great deal, it's essential to ensure that the company offering the buy-down isn't making up for it with extra fees elsewhere. While a buy-down gives you a temporary break on the interest rate, it's important to remember that your payments and total interest might actually be higher over the long term. This is why buying down your interest rate is a strategy that requires careful consideration and calculation of long-term benefits. If you're considering a buy-down, here's a tip. Make sure to compare a mortgage with and without a buy-down. Lenders will qualify you based on the permanent interest rate, not the temporary buy-down rate. So it's crucial to understand the numbers and what they mean for your financial future. And lastly, be prepared for your monthly payment to increase at the end of the buy-down's discount period. This is because the interest rate will revert to the original, higher rate once the buy-down period ends. In conclusion, a buy-down can be a useful strategy for reducing your mortgage interest rate in the short term. However, it's important to weigh the potential benefits against the possible increase in payments over the long term. Always compare a mortgage with and without a buy-down, and prepare for your monthly payment to rise at the end of the buy-down's discount period. The third strategy is choosing an adjustable rate mortgage. This particular mortgage product tends to rise in popularity whenever rates begin to climb. But what exactly is an adjustable rate mortgage, often abbreviated to ARM? Well, an ARM is a type of mortgage loan where the interest rate is not fixed for the entire life of the loan. Instead, the rate is initially set for a specific period, often between 5 to 10 years. After this introductory period, the rate will adjust regularly, typically once or twice a year. This adjustment is based on changes in a reference interest rate, such as the US prime rate or the London Interbank offered rate, plus a margin decided by the lender. Now, you may wonder why someone would choose a mortgage with an interest rate that can change. The answer lies in the potential benefits. ARMs generally offer a lower initial interest rate than a fixed-rate mortgage. This lower rate can result in significant savings during the introductory period. However, ARMs are not without their risks. As the name suggests, the interest rate can adjust, meaning it can go up. If the interest rate increases significantly, so could your monthly mortgage payment. So, when shopping for an ARM, there are a few tips to keep in mind. First, look for an ARM that offers an introductory rate lower than what you could get with a fixed-rate mortgage. This difference is where the potential savings come from. Next, choose a term that aligns with your future plans. If you think you'll move or refinance within the next 10 years, a 10-year ARM could be a good fit. Finally, and perhaps most importantly, make sure you budget for potential rate increases. Ensure you would still be able to afford your mortgage payments if the interest rate rises. This is a critical step in making an informed decision about whether an ARM is the right choice for you. Make sure to choose a term you're comfortable with and budget for potential rate increases. The fourth strategy is improving your credit score. This might sound like common knowledge, but it's surprising how this crucial aspect is often overlooked. Your credit score plays a significant role in determining the mortgage rates you're offered. A higher score translates to more trust, and more trust translates to lower interest rates. So, how can you improve your credit score? First, it's crucial to understand what makes up your credit score. The two key elements are your payment history and the amounts you owe. These two make up about 2/3 of your credit score. So, maintaining a consistent track record of timely payments and keeping your debt levels low is a surefire way to boost your score. Second, it's essential to be patient. Improving your credit score is not an overnight process. It requires time and discipline. It's like a marathon, not a sprint. So, don't be discouraged if you don't see immediate results. Keep at it and you'll see your score gradually improve. Third, keep your credit utilization low. This is the ratio of your total credit card balances to your total credit card limits. It's recommended to keep this ratio below 30%. The lower, the better. So, if you have a credit card with a limit of $1,000, try to keep your balance below $300. Fourth, avoid opening too many new credit accounts at once. Each time you apply for credit, it can cause a small temporary dip in your credit score. Too many of these in a short period can add up. Lastly, check your credit report regularly for any errors. Mistakes happen, and you don't want to be penalized for an error. If you find any inaccuracies, dispute them immediately. In conclusion, a good credit score is your passport to not only getting approved for a mortgage, but also securing the best possible rates. It's worth the effort to invest time and resources into improving it. Always aim to maintain a good credit score to get the best mortgage rates. The final strategy is making a large down payment. A hefty down payment isn't just about showing lenders that you're serious about homeownership. It's about reducing your loan-to-value ratio, which is a key factor that lenders look at when determining your mortgage rate. The more equity you have in your home from the start, the less risk the lender takes on, and as a result, the lower your interest rate could be. In fact, with a down payment of 20% or more, you can often avoid paying private mortgage insurance, which can add to your monthly mortgage costs. So, how can you save for a large down payment? There are several strategies. You could set aside a portion of your income each month specifically for your down payment fund. Or consider automating your savings so a certain amount is transferred to your down payment fund each paycheck. It may also be worth looking into down payment assistance programs offered by local and state governments. These programs can provide grants or loans to eligible home buyers to help with down payments. And remember, while a large down payment can help you secure a lower mortgage rate, it's important to maintain a balance. You don't want to deplete your savings completely to make a large down payment. Always ensure you have a financial safety net in place. Making a large down payment can significantly lower your mortgage rates. In conclusion, securing a low mortgage rate in 2023 requires strategic planning. Remember the 5 strategies: buying discount points, considering an interest rate buy-down, exploring adjustable rate mortgages, improving your credit score, and making a sizable down payment. With these strategies, you're now equipped to secure the lowest mortgage rates in 2023.